This week, the FOMC has yet again raised interest rates 50 basis points, making the Fed overnight rate 4.5% effective December 15th. Now, the FOMC meets 8 times a year, and this meeting's increase represents rate hikes in 7 of the last 8 meetings. And this is all since March 17th. In this video, we're going to capture the highlights from the Fed's recent meeting and talk about what this means for you and I in the economy and the housing market. Hey, thanks for tuning in, everyone. Let's start by taking a look at the recent rate hikes, the 7 rate hikes out of the last 8 meetings from the Fed. This chart on Forbes.com shows the rate changes at each meeting and the recent rate hike of 50 basis points, which makes the range from 4.25% to 4.5%. So what does this mean for American consumers? Let's break it down. But before we do, I want to mention while we're looking at this chart, though this week's increase shows a 25 basis point step down from the 75 basis point hikes that have occurred in the last 4 previous meetings, 50 basis points historically is still a major hike. Now, what is the federal fund rate and how does that affect you and me? The federal funds rate is also known as the federal funds overnight rate. It's the interest rate that depository institutions and other lenders can lend or borrow money. This is what's set by the Federal Reserve Committee. The banks and lenders then take this rate and mark it up to you and me when they lend us money. So if I'm a lender and I can borrow money at 4%, and then relend that money to you at 8%, as long as you pay me back as agreed, the additional 4% on top of what I paid as the lender is the profit that I made lending the money. So as a U.S. consumer, if you need to borrow money, otherwise we know it as consumer debt, the federal funds overnight rate ultimately affects the amount that you pay on like unpaid balances of your credit cards, your auto loans, and other types of revolving consumer loans. Now, I'm not a lender, and before we go any further, I want to disclose that the information that I'm sharing with you today is based on my own research and my very limited understanding of this very complex monetary system. So what I'm saying, guys, is do your own research as well. And I'm sure if you find any inconsistencies or inaccuracies on what I'm saying here, you'll let me know in the comments below. Now let's talk about how these 7 rate hikes this year have basically halted real estate sales and what I believe that this is going to mean for the real estate industry in 2023. But before we do, I'd like to address who are these people that are making these monetary policy decisions? So the Federal Open Markets Committee, also as we know it, the FOMC, meets 8 times a year and consists of 12 members. 7 of these committee members are from the Board of Governors of the Federal Reserve System, as well as the President of the Federal Reserve Bank of New York, and the 4 remaining members are Reserve Bank presidents who serve on a revolving basis for a 1-year term. The Federal Reserve controls tools of the monetary policy. The links below to the monetary policy, you guys can take a deeper dive if you'd like to, but I'd like to tell you that during my research, I became aware that the Fed had eliminated one of these 3 major tools, and I personally found this disturbing. And this is the tool called reserve requirements. And by the way, this tool is still listed on the Fed's websites as one of the 3 tools. But when you click the link, it says that basically this tool was eliminated in 2020. So this reserve requirement was a percentage of the overall deposits held by that bank that they actually were required to keep that percentage in cash in the bank vault overnight to protect them and their customers from something called a bank run. A bank run occurs when the bank deposit customer fears that the bank could become financially insolvent and large groups of depositors could show up at once to withdraw their money. Now, unfortunately, on March 26th of 2020, the bank's reserve requirement was reduced to 0, essentially eliminating the bank's vault reserve requirements. Geez, maybe this is why so many people don't feel comfortable putting their cash in the bank. So now that you are equipped with so much more knowledge on the U.S. monetary policy and the makers of the same, let's see what occurred this week in the FOMC's press conference as a result of their December meeting.
Before I go into the details of today's meeting, I'd like to underscore for the American people that we understand the hardship that high inflation is causing, and that we are strongly committed to bringing inflation back down to our 2% goal.
Now, as we know, inflation has been a runaway train for at least the last 2 years. And a lot of this is partly due to the Fed reducing the rate that we've been talking about to almost 0%. This helped to create inexpensive consumer debt and drive mortgage interest rates to all-time lows. And this coupled with unheard of stimulus and printing more money in the last 2 years than we have in the last 200. Along with supply chain issues and labor market demand, it caused prices in almost every category to skyrocket and simply blew out the budgets of every American consumer. So real estate, also known as shelter inflation, is at an all-time historical high. And it's stated as one of the main reasons that over 9 million millennials have moved back home with their parents in the last 12 months alone.
Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by a 0.5 percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
So leading up to this meeting, many of my real estate colleagues had believed that the Fed would pivot in light of recent news of inflation coming down. Now, you just heard Jay Powell yourself stating that ongoing increases would be appropriate in the future. So no pivot. So get ready, because 2023, I believe, is going to be a very interesting year. Now, Powell just said that overall consumer spending is slowing, and this is largely because of the lack of cash and obviously from increased cost of life's essentials. So now, no surprise, we're seeing consumers pull back in their spending. And this is going to have a negative effect on a lot of our businesses, and I believe ultimately it's going to cost us jobs. And I can tell you personally that the last few times that I've been out to a restaurant having dinner, the places really aren't busy. And I specifically remember going to the grocery store just before Thanksgiving, remembering how packed it used to be. And even then, I was surprised during prime shopping hours, the lines weren't that long. So let's listen to the man himself.
Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment.
So yes, the housing market has slowed. And Jay Powell says that this is because of increased mortgage rates. I think that may be one contributing factor, but I think, as he said previously, overall consumer spending is down because consumers just simply no longer have the cash. So this is a problem for anyone that wants to buy a home, sell a home, or certainly anyone working in the real estate industry that is dependent upon real estate sales for your income. Now, as more projected rate increases are observed, though not directly affected by the Fed's hike in interest rates, historically, mortgage interest rates typically follow the same trends. Unless we see some major correction to house prices in the near future or some type of massive wage growth, we may continue to see home sales across the country come to a near halt.
We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go.
Now, for what I consider all pencils down, folks.
As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a 0.5 percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value.
All right, so you heard it. 5.1% interest rate the Fed is predicting at the end of 2023. That is yet more expensive than where we are today. And he's predicting that by the end of 2024, we will see interest rates from the Fed at 4.1% target rate. And that's only a little lower than where we are right now. So now what? With these higher interest rates and consumers having less cash, with the increase in rents, food, utilities, fuel, transportation costs, will it not be until 2025 until we see some financial relief? Now, for anyone serving the real estate sales industry, you may want to hold on to your seat. And as my friend, fellow realtor, and YouTuber Scott Walters says, buckle up and strap in. We're all in for a ride, whether we like it or not. And if you're a buyer or seller, I'd love to hear from you. Drop your comments below. And certainly, I'd love to hear from real estate agents and anyone affected by this real estate downturn. And one of the ways that you can let me know if you like this video is hit the thumbs up. Guys, it'll let me know that you did. And if you're watching our channel for the first time or you just haven't subscribed yet, you can smash that subscribe button now. Hit the alert bell. You'll know every time we upload content just like this. Here to keep you informed, guys. See you next time.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.